Good morning, everyone, and thank you for another edition of Ancillary Wednesday. Today we have Ronnie Lipinski. He is the national trainer for Aetna. He's also an agent. So things that he has to share with you today, he's not only talking about, but he is preaching in the field. He is practicing what he's preaching, for a better word. Um, he's going to go over two or three products today, some at a high level, some at different intervals. But the thing I want to get across is that he is going to show you what is needed, how he succeeds, how his agents succeed, and what you need to look and take forward and to be successful in showing ancillary and making this more and more successful as part of your portfolio. So, like I said, without any further ado, Ronnie, thank you so much for joining us today, and looking forward to learning myself even more and more. And Ronnie, the floor is yours. Thank you again.
Right. Thank you, Joey. Good morning to everybody. Again, my name is Ronnie Lipinski. Been an agent in the field for 23 years. I was talking with Joey just a little bit ago. Long-term care was my specialty. I still love long-term care, but long-term care is kind of being phased out and it's more hybrid and people are living a lot longer. So we've transitioned to short-term care about a decade ago and we hit the ground running and we haven't stopped. So that's a little bit of the bio on me. I do MA, Med Sup, maybe a little bit of ACA, but I do a lot of cross-selling with these ancillary products. So that's what I'm going to bring to the table today. I always like to start out with Aetna on the screen because I'm licensed and appointed with all the major carriers. I have all the different types of policies out there available to me. But for these particular policies that we're going to talk about today, my go-to is Aetna for a couple of different reasons. One, with the name on there, they've been around for 170 years along with CVS. I don't have to sell that brand. So that's one less hurdle that I have to overcome because of the branding with Aetna. But more important than the branding is the people behind the Aetna name, policy service, underwriting, all the different people that my clients might have a conversation with. And as an agent, my biggest asset is my book of business, and I want and protect my renewal. So I'm entrusting all that to Aetna. And I can tell you with over all the years that I've been selling Aetna now for 14 years, my renewals retention rate has always been at over 90%. So that's the reason why I love Aetna. They're an agent friendly carrier. They value our input, and they also know that their clients, their policyholders are important to them because they have other carriers that are available to them. So they try to do the best job they can for the agent and the policyholder. So with that being said, let's go. These slides right here, Medicare, I'm a Medicare geek. I'm a Medicare guru. Everything is Medicare. So when I'm in a house sitting in front of somebody or I'm doing a telesales call, I want to give them a high level education and walk them down the history or at the trail of Medicare, what's going on. So as agents, it's very important for us to keep up with these changes, with the cuts and gaps, so we can explain how their cost share is going to be if they have a Med Sup, or what their co-pays or benefits or exclusions that are not covered because of the changes with Medicare. So I really highly recommend, if you haven't did a deep dive into Medicare and go over that Medicare and U book and what's going on with Medicare, I highly suggest you do. There's going to be a couple pages that we're going to address later on in this slides to show you what I use when I'm in a house. But I'm a really big proponent for letting them know how Medicare is going to affect their plan that they're currently on. Because with me, need is everything. If I can get the need across, which I do, then there's no problem fixing the gap that they have. These slides right here are my cup of coffee. Medicare 61 beneficiaries, which is 18% of the population. But this slide right here really gets me going. Enrollment is expected to rise to 79 million by 2030. There's not enough agents, not enough brokerages to keep up with these amount of people. There's a lot of money to be made out there, and there's a lot of people that need our help because they get bombarded with all these commercials, all this stack of confusion information that comes in every year. AEP, we're the experts to navigate the changes in the Medicare or their Medicare Advantage plan and help them understand what their out of pockets are and what the changes are and how it affects their particular plan. But I love this slide. This slide's actually on my mirror. And so when I wake up in the morning, I see this and it makes me like, let's go, because there's so many people out there that need our help. So with that being said, when I'm in the house, what I do is I just take them down the trail of Medicare and let them know that, under the Johnson administration in 1965, they implemented Social Security and Medicare, which did a lot of great things for a lot of those people and continue to, because back then when they started Medicare, people didn't live very long. You girls were 74, about 74 age, and us guys around 67. Over the years, because of better medicines and technology and because of insurance being better, we're living a lot longer. Females are living into their 80s, us guys late into our 70s. Medicare never foreseen or never put anything in there for people to live a lot longer. They thought that people would be on Medicare for maybe 5 years, 10 years, but that's not the case. So they're struggling to keep up with the amount of people existing on Medicare, which is causing a big problem. When Medicare started out, there was a lot more people paying into Medicare than people receiving Medicare, and it's going to continue to go down. And that's where the problem is on Part A, because there's not as many people paying in, as people receiving. So that's where they're really struggling, and they're struggling on that hospitalization side. This is something that I show my clients, even though this is from the CBO, and this is what they did from 2013 to 2022. They had all these cuts, all the different types of care. So hospitalization, 260 billion, MA, 156, home healthcare, 66 billion, skilled nursing, 39. It's a total of $716 billion in cuts. That's where those changes are coming from on the Part A. And as you can see, the spending is going to be projected to be around 1.3 trillion by 2025 next year. So the spending isn't going down. The cuts aren't going to quit being cut. So Medicare is faced with, that's why we see so many people being thrown into MA to kind of offset the losses for Medicare. But this is what Medicare is dealing with. They don't like readmissions because it costs them so much money. About 1 out of every 5 patients are readmitted. So I explained to the people sitting across the table from me about what's going on with Medicare, what they're doing with readmissions and inpatients, because they have auditors in all the hospitals. And if Medicare finds any discrepancies, as this slide says, they fine the hospitals. So what I have done is I've scoured all over looking for different things to back up that data and the information I'm telling them. And this was a clip from Indiana talking about readmissions.
Patients are being readmitted to hospitals. Officials say it's costing you billions of dollars a year. Now, several Indiana hospitals are looking at fines because of it. 66 Indiana hospitals will be docked $12 million total next year. That's in Medicare payments. Federal officials say too many patients came back for care within a month of being discharged. Only 17 hospitals in the state will not be penalized. Officials say readmissions are often unnecessary. They say it's usually because of treatment that should have been prescribed during the first visit.
So Indiana isn't the biggest state in our United States, but out of 66 hospitals, only 17 were not fined. That's a big problem. And so now you have Medicare telling these hospitals what is a correct readmission or correct inpatient, and they're finding these hospitals. So the hospitals, as we know it as patients, are a place to get better, but they're also a place of business. And when you're taking money away from a business, that's not a good business plan. So with these audits and these penalties, it's changed the way hospitals are doing things with readmissions and inpatients, which causes the patient to be caught in the middle of the hospital and the Medicare struggle, which they're going to have more out of pockets because of it. So what's happening in every hospital across the whole United States, they have RACs. And then bottom block, you can see they receive compensation from Medicare when they find any discrepancy. So anytime they find the smallest minuscule discrepancy, they'll make that hospital stay invalid and they'll take that payment back, which isn't good. So what the hospitals have tried to do is they've tried to get on the same page with Medicare because they don't want to be penalized, but they haven't figured out how to get around it. So this is what they've came up with through the lawyers. And most of you, or some of you might know this, and this is exactly what they're doing. They're putting people under observation. If you don't know what observation it is, it means that you're technically an outpatient. So when you're in the hospital and you're supposed to be an inpatient, everything goes through Part A. Well, guess what? When you're under observation outpatient, it isn't being filtered through Part A like it's supposed to, which causes the insured to have more out of pockets for services in the hospital and when they leave the hospital. And as you can see, it keeps increasing. It's not going to stop. They're not going to stop doing the observation because they found that that's working for them to cut down on payments. So if you haven't gone into the Medicare and U book for 2024, this is page 28. When I'm in a house, one of the first things that I do after I've introduced myself and explained, the purpose of the visit, what we're going to do with their Medicare review and do a 101 with them, I have them go get their Medicare and U book if they have a Med Sup. If they have a Medicare Advantage, I'll have them go get the Medicare book and their summary and explanation of benefits in their MA plan. I have them go get those books for a couple of different reasons. One, I want to have control in the house. And two, I want to show them what I'm talking about with the information that they have. So as you can see at the top, am I an inpatient or outpatient question mark? And I'll say, hey, Mrs. Johnson, why do you think it has a question mark on behind why I'm an inpatient or outpatient? Because if you stayed 24 hours, wouldn't you consider yourself an inpatient? And they always say, yes. It'd be silly not to be. Then I go on to read whether you're an inpatient or outpatient affects how much you pay for hospital services and if you qualify for Part A skilled nursing facility coverage. And it even says, even if you spend a night, you can still be considered under observation. You only become an inpatient after the hospital formally admits you with doctor's orders. If they don't, you are considered outpatient. And then I'll read them in that bold black print where it says each day. So on Wednesday, Mrs. Johnson, you're in the hospital and have an inpatient. Come Thursday, you need to ask them again because you might be under observation. And Friday, you might be under observation. When you get discharged, you've technically only stayed in that hospital one day. So if you go down to skilled nursing where it says medically necessary, highlighted in blue, it'll tell you Medicare only covers these services after a 3-day minimum medically necessary. And then I say, what does it say, Mr. Johnson? Inpatient hospital. So if you're not in there for at least 3 days as an inpatient, you're not going to get those 20 days that you usually get with Medicare for skilled nursing. Now on the MA, it tells you may not need that 3-day hospital stay, but to check with your plan. I've had 5 people call me this year that I've sold MA to that did not get the first 20 days. And secondly, I've noticed on a couple of different carriers this year, they're charging a copay for the first 20 days, and some of them are charging a copay for the first 10. So where I used to be able to say the MA didn't have to comply with the observation, they are now, some of them are making you, they're having to apply that observation where they're not going to get it, or they have their copay starting at the first 10 days or first 20, where it used to start from the 21st day. After I go over those pages on the Medicare with page 28 and then in their MA book, I play this video right here because this is a testimony of everything that I just went over with a little bit of history of the Medicare. People are living a lot longer, how it's affecting Part A, and then what's going on with the observation. Then I play this video because this is a testimony of a lady named MJ. She broke her leg and this is what happened to her.
79-year-old MJ Bricu is doing physical therapy after a bad spill in September. She spent 3 days in a hospital. She got the same care as an inpatient, but she wasn't classified as one. Instead, her chart said she was only under observation.
I mean, it's illogical. I had a broken leg. It just didn't make sense at all. What were they going to observe?
And here's what she didn't understand at first. That label, under observation, technically made her an outpatient. And that means Medicare won't pay for her rehabilitation in a nursing facility, which costs $28,000.
The whole thing is so outrageous, and it's not right.
It's a huge problem. There are over 1 million, almost 2 million people every year who are stuck in this observation status, Alice in Wonderland world.
To the patient, to our viewers, frankly, it seems like the hospital shares at least part of the blame for this.
Sure, they're in the hospital. They're going to think all of this is a hospital decision. Much of this is out of our hands.
Rich Umdenstock, who represents most of the hospitals in this country, says they're being squeezed by Medicare. Inpatients cost more, so Medicare aggressively audits the classifications given to patients.
If you make the wrong decision, if you admit a patient to inpatient status, And then they determine after the fact, sometimes years later, with additional information the physician didn't have, they will take that payment back. Unfortunately, the patient does get in the middle of this.
We wanted to talk to Medicare, but they denied our request for an interview, citing pending litigation on this very issue. The hospital that treated Mary Jane wouldn't talk to us either, but gave us a statement saying it is obligated to follow Medicare rules when assigning patients to their appropriate level of care. MJ finds the whole thing unfair. She and her husband, who's had Parkinson's for 20 years, just moved in with their son in Dallas to save money.
I've worked my whole life, and I'm just appalled.
Now, any money they can save will go to her rehab.
So after I get done with page 28 and I transition into that video, they are leaning in really, really close, and their eyes are opened up and their jaws are on the table, because this explains everything that we want to put across to them, why they need this particular thing fixed with the different policies that we'll offer to them. But this is a problem, and this isn't going anywhere. Observation is a pandemic right now across the country, and people are losing a lot of money, just like MJ. She thought she was good. She had Medicare, and she had her Blue Cross Blue Shield, her Medicare supplement. She thought she was golden, her exact words. But because of a broken leg, she ended up spending $28,000 that she didn't have budgeted for an accident, sickness, or surgery. She spent that money, and that caused her to have to move back in with her son to save money, because her husband has Parkinson's, which they don't have a policy for. So it's really unfortunate for them. And the lawyer even said the patient gets caught in the middle because they're being squeezed by Medicare. So when I play that video for them, after I did that high level of a Medicare history background and how it's affecting Part A, man, and you put that video in there, that really brings them in. I usually get, after I play that video, hey, how can we fix this? Or what are we going to be able to do to get over this observation? Or am I just stuck with it? So as we know, 70% of the people that age 65 and older are going to spend some type of time in some type of recuperation. So there isn't a question that it's going to happen. What are we going to do about it? There's a need. So we don't want our clients to be faced with the same bill that MJ had. So it's our job to educate them and to let them know what's going on with Medicare, how to fix their insurance, and then how we propose to fix it for them. As a long-term care guy, I was always trained to sell 3, 4, 5 lifetime benefits. As you can see, with people living a lot longer, for guys, most of the nursing home stays is less than a year. For you girls, it's just under a year and a half, and more than a year, 22%, 30%, 36%, and more than 5 years is really low. So people aren't staying in the nursing home like they did in yesteryear for long periods of time. Yes, if you get dementia or Alzheimer's, you might stay more than a year, but the statistics don't lie. So the short-term care plans have taken over the long-term care plans, in my personal opinion, because there's less underwriting, they're more affordable, and they cover basically the same benefits as a long-term care plan does for the fraction of the cost. So that's why I've switched from long-term care to short-term care, because I don't have the problem with the underwriting or the premiums or anything like that. And as you can see with these statistics, that backs it up. Another thing that's going on is low reimbursements for home healthcare agencies. So if they have someone that's coming out of the hospital under observation, they're going to get a lower payment. So they're going to be faced with the choice of choosing, someone that's not under observation versus someone on observation. I've heard from a lot of my clients that, they're having trouble, sometimes finding a home care when they're under observation. So it's just something to keep in your memory bank. So if your client asks you about that, you can give them some intel on it. Here's how I fix that observation debacle problem that we were just talking about with recovery care. I love recovery care. It's a great, great policy. I love that Aetna reached out to agents that were familiar with the long-term care and sold long-term care and got their input. They picked their brain and they implemented a lot of the things that they wanted in this policy. So that just lets you know that Aetna really appreciates, us agents, and they know we're the ones out there selling the products. They're not. So they really wanted to know what we wanted. So they knocked it out of the park, the actuaries, I think, 50 to 89. ages, no gender, no height and weight chart. For me, that's a big deal because when I was selling long-term care and, Mrs. McGillicuddy was 5'5" and 200 pounds, but she can walk up and down the steps and garden, but they would consider her obese. I wouldn't be able to ride her. No underwriting, no phone interview. So I don't have to be on the phone for 25, 30 minutes anymore with my clients as they're doing a phone interview. No medical records. It pays in addition to any other insurance. That's a great selling point for me because if they do get the 20 days from Medicare with the recovery care plan, they will get a check. So if they get a $200 a day benefit and they're in there for 10 days, they're going to get a $2,000 check tax free that they can put in their HSA account. They can go out to dinner. They can pay future premiums. They can do whatever they need with that. So I love that pays in addition to any other insurance. No hospital stay in any licensed nursing facility or any licensed home health care agents. The bottom right-hand block is big for me. Renewal premiums do not increase because of age or health. Aetna has been servicing and doing these products for over 3 decades, 34 years. They have had not one rate increase. That's why I say the actuaries knocked it out of the park. They did their homework. They did it right. And what a comfort to me as an agent to know that my clients aren't going to be getting a letter saying that their premium's going up, like some of my long-term care clients. That doesn't happen. I love that about that. It keeps my book of business on the books, like I said, over 90%, and keeps my renewal growing and growing and growing. So what are the benefits? Here's the benefits. Goes up to $400 a day. So if you gave them a $400 a day benefit, they would have a monthly benefit of $12,000, a yearly benefit of $144,000. That's a spectacular benefit. But let's say you're in a house where they have less income, because all of them are on fixed income. They get Social Security. Some of them might get a pension, and some of them might get interest and dividends off their investments. If I'm in a house that's just strictly where they only get Social Security and their house is their biggest investment, I might give them $200 a day, but that's $6,000 a month, $72,000 a year. So I really gauge the premiums based on the people sitting in front of me and what their income level is. They have a choice of covered days, anywhere from 90 to 360. I sell a lot in 90-day benefits because I call it their recuperative care or extended care. And I run into long-term care a lot when I'm in the field. And most every long-term care company has what they call elimination period or a waiting period. And most of them are 90 days. So if you run into a house, I ask them for all the insurance that they have, because I want to know what their portfolio is. I already know what their Med Sup is, their Medicare Advantage, but I don't know if they have cancer, heart attack, stroke, life insurance, or long-term care. So I ask them what other insurances they have, because sometimes they'll have that long-term care, they'll go get it, and I know it has a 90-day elimination period, and I'll pull that policy schedule page open, and there it is. So I sell a lot in 90 days, but they come in 180, 270, or 360. Whatever benefit you give them, they can get up to potentially twice the number of covered days. So let's just stick with the 90 days. If you give them a 90-day benefit, just picture your hands out in front of you, a left hand and a right hand. Your left hand is going to have one bucket with 90 days in it, and then they get twice the amount. So the right hand is also going to get 90 days. Say they fall and break a hip, they go into the nursing facility, and they have to be there 30 days, and then they get discharged. That left-hand bucket now only has 60 days benefit, but you still have 90 days potentially in the right hand. If they can go for 180 days after their discharge from the nursing home, and they can complete and do 5 out of the 6 activities of daily living, and then after 6 months, maybe they have a stroke, they can go into that second bucket and utilize all those 90 days and go back into the first bucket if they have to. Let's say they get out of the nursing home and 2 weeks later they have a reoccurrence with their hip. They can go directly back into the first bucket because there's no waiting, but they don't have the ability to go into the second bucket because the qualifier has to be 180 days time elapsed since their last rehabbing. So that's how that example works. If you go into aetnaseniorproducts.com and go under the training videos, they have a more in-depth, detailed explanation, but they use the same analogy of the buckets, and they use a stopwatch for the 180 days. It does come with waiting periods. I never sold a waiting period. I'm always a first day coverage guy. But if you choose to, that's okay. But I did the math and giving them a 20 days and 100 days at the end of the year, the savings that they're going to save on their premium really doesn't add up to me if they have to utilize the policy. But they do have 20 days or 100 days, and it does give them a little bit of savings, but it just doesn't add up to me to make much sense to do it. If they want to have a claim on this particular policy, it's going to be based on activities of daily living or cognitive. So if they can't perform 2 out of the 6, that's one proponent for them to start the claim, or if they have cognitive issues. And just like long-term care, it has bed reservation up to 20 days, which means if they were in the nursing home and they were there 2 weeks and they had a heart attack and they had to go back to the hospital, they would reserve their room so they don't have to switch rooms. So that's what bed reservation is. It has a killer. Love this home care rider. It goes up to $1,200 weekly. So if you gave them a $1,200 weekly benefit, that would be a $4,800 a month benefit. So it's a great benefit. Again, it comes with the a la carte 13, 26, or 52 weeks with the same maximum. So if you give them 52 weeks, they're going to get potentially up to 104 weeks. And it's the same buckets that we talked about on the nursing home. With the qualifiers for a claim on the home care, there has to be 3 separate visits a week for at least 1 hour because they can't perform 2 or more of their activities of daily living or cognitive. But here's the cool thing with this policy. It doesn't have to be skilled. It doesn't just have to be physical therapy, occupational therapy, speech therapy, or help with their medicines. It could be the personal care. That can be a visit. That would count as 1 visit. It could be like housekeeping and laundry. That would be considered a 2nd visit. And then they had physical therapy or occupational therapy or speech therapy. There's their 3rd visit. And it would be set up by a doctor. That have to have a plan of care. But I love that they're able to utilize the home care part of it as far as the homemaker services as counted as one of the visits. That is key. If you don't use or know about the Genworth cost of care, I highly recommend it because how I utilize this is when I'm in Indianapolis or if I'm in Sarasota, Florida, or if I'm in Austin, Texas, I can go directly into their state, right down to the road, whatever nursing home that's down the street from them, and let them know what their costs are going to be. So I'm going to know what home care cost is going to be, their homemaker and their aide. I'm going to know what assisted living is going to cost. I know what a private room or semi-private room is going to be right down the road from them with this because I like to spend their money. I let them know if you're like MJ and you break your leg and you have to go in here down the road, it's going to cost you almost $8,000 for 1 month of care. So I go a deep dive with that money. I like to make it real for them and let them know because of the current state of their insurance and because of observation, these are going to be your cost share. This is going to be your out of pocket. So if you don't have the Genworth Cost of Care app, I highly recommend for you to get it. It's a great tool for us agents to show to get that need across because of the money out there. And then I just take it a step further. I'll find out what the cost is in their area, and then I'll write it down for them. If you go into the nursing home, Mr. Johnson, it's going to be $268 a day, $8,000 a month, $98,000 basically a year. So now they start seeing real money being spent. They know how long it took them to make $97,000 and to save $97,000 and the different things they had to do and sacrifice to get to that point. It goes quickly. They can hemorrhage money quickly. So I let them know what their costs are going to be because they don't have the proper coverage and with the observation. So I go down the line with the assisted living. You're going to spend $50K. If you're in home healthcare, having full-time healthcare, $60K. That's a lot of money to the people that are 65 and older because remember, their mom and dads were in the depression and they taught them to save and to sacrifice and not to squander the money. And now they're faced with these big numbers. It's a big deal to people. And I have found over the years, when I'm showing them the money and spending their money, they're really wanting to fix the problem that's in front of them. If someone doesn't want to go to the nursing home with the recovery care, you can do a standalone home care policy, which is good. You just give them the basic benefits for the nursing home. and then you can max them out on the home care. And then they got a true home care policy. When I was selling the long-term care, I had to give them nursing home and assisted living to get the home care. Don't have to do that with the recovery care plan. If they just want to stay at home, you can max out that home care, and they have a true home care policy, which I love. The application usually takes me about 5 to 10 minutes, maybe max, if it's a husband and wife. It's just simply yes or no questions. Are you currently confined to a hospital? You need a wheelchair or a motorized device in the past 3 years, 36 months. Have you had any tests or surgeries for, congestive heart failure or any type of cancers? Past 24 months, any strokes, TIAs, 3 or more times in the hospital? Question 4, I want to bring your eyes to, because it's a diabetic question. This particular policy, if they're under 50 units, 49 units or less, they can get this policy. That's big for me, because whenever I came across someone that was using insulin when I was selling long-term care, it was a definitely knockout. Not with this particular policy. As long as they're under 50 units daily, they're qualified for this particular policy, which is awesome. I did some premiums for you, 100, 200, 300, and 400. As you can see, if you gave them $200 a day, it's less than $1,200 a year. So whenever I propose my plan and I let them know what the premium is, I'll say it's $84 a month, $1,100 a year, because the monthly number might seem big to them, but when you give them the annual number, it seems small. So I've just learned that over the years by giving the monthly, but then also backing it up with the annual. But even if you gave them the $400 one, you're still under $2,000 a year. And when we showed that last slide, it was $97,000 for the year out of pocket that they would have to spend. And then you can tell them they can invest $2,000 a year to take care of that $97,000 bill. They're jumping on that quickly because they understand the difference in money. They much rather invest $2,000 or much rather invest $1,200 a year versus having the heartache of hemorrhaging money out of their pockets that they've earned over those years. So I don't have problems with premiums, because the premiums, Aetna, I think, knocked it out of the park with the actuaries, because they did it with the fixed income mindset. And even, like I said, even the $400 is under $2,000 a year. So I just really are thankful that they looked at the fixed incomes with the people that are 65 and older. If this is what I call the base plan, the 90 days, I sell a lot of it, but you can see right here, even if you gave them $400 a day, it's under $700 a year to cover the observation, because I sell a lot of recuperation and extended care. That's how I pitch that recovery care for those 90 days, because I'll give them that 90-day benefit. So even with the MA clients, a lot of people think it's a myth that Medicare Advantage people don't want to spend any money. I debunk that myth every single day, because about 90% of the people that I see have MA plans, whether it's a retirement plan or a street level plan. I sell them all day long, as you can see, because the premiums aren't bad at all. So if you're in Texas, or if you sell in Texas on the recovery care plan, they don't have the home care rider. So they came up with a specific plan just for Texas for home care. It's the same as the recovery care home care, as far as no weight, height chart or anything like that. But look at the benefit. You can give them $3,000 weekly. It's a $12,000 a month, $144,000 a year home care policy. So it works just like the home care rider on the recovery care. So with the 3 separate visits, you can use the personal homemaker services or the skilled. So it's an awesome policy. I can't wait until it's in all the other states, but for right now, it's in Texas only. So if you're selling in Texas, it's a beautiful policy. I mean, it is awesome. Same questions as the recovery care. Here's the premiums. I just took out 1,050, 1,500, and 3,000. As you can see, if you gave them 1,050, which is going to be over $4,000 a month, close to $55,000 a year, again, you're in the $600 to $700 a year bracket. If you gave them 1,500, which is a huge benefit, $6,000 a month, under $1,200 a year. So I just don't have problems with premiums because they really did a great, fantastic job on figuring out the premiums with this particular policy. And you can give somebody something that they need. It might not necessarily be the $3,000, but if you gave them $1,500 a week, $6,000 benefit is a huge benefit, $78,000 a year, and it's less than $1,200 a year. So I really don't have problems with premiums, no objections on premiums. If I do have a client that has one of these conditions, typically you're not going to be able to get them anything. But what Aetna did is they came up with the Home Care Plus. So this is my backup policy. If I'm selling a hospital indemnity or a recovery care plan and they can't get it because they have taken a drug or they answer one of the questions, yes, this is my go-to. It's a skilled home care policy. Again, no height, weight, and chart. I always throw the e-app on this one because I highly recommend you doing the e-app, but the renewal premiums do not increase like the other ones. But this is a spectacular and awesome fallback policy to the recovery care in the hospital indemnity flex plan, because if they're unable to get that, they can get this particular policy, and it's a blessing for them. As you can see, the benefit was up to $1,200 a week. Us agents asked for a little bit more. Aetna said okay, and they gave it $1,500, which is a good. Again, they're agent friendly. I love that about them. Same way on the hospital indemnity copay, they raised it up to $400. So, like I said, if you have an MA client, you can fix their hospital copay with this particular plan if they can't get the flex plan. But it goes up to $1,500 a week, $6,000 a month. Same 13, 26, 39, 52 weeks with the same maximums. So this is an awesome policy because someone with Alzheimer's is not going to get any other policy. It also has a lump sum cancer. I always throw the cancer on because it's very inexpensive. So first diagnosis of cancer, and if you gave them the 10,000 lump sum, they're going to get a check for $10,000. So I always throw the cancer rider on this Home Care Plus policy. So it's really a cool policy. Whether you have an MA client or traditional med sup, the questions on here are, there it is right there. It doesn't take any time to go over the questions on the Home Care Plus. Same first 3 questions as there was on the recovery care, but that's it. If you sell them the cancer rider, they have 2 extra questions for the cancer rider, and it's within the past 10 years. That's it. That's all the questions that you have on that Home Care Plus. So they're good questions. They're in-depth questions. I don't think you need to gloss over them and rush through, because what they do as far as Aetna underwriting, they use the Milliman program, and it does a prescription check, and they'll cross-reference those prescriptions with the questions that you gave them. So it's important to make sure that you go over the questions thoroughly and make sure that they understand whether it was within 12 months or 36 months or 24 months. But here's the premiums. Just at a glance, 13 weeks all the way up to 52 weeks. So even if you gave them the 26 weeks, it's under $1,200 a year. If you gave them the 52 week at $1,500 max, it's under $1,500 a year. So again, I go back to that Genworth cost of care app and what it would cost them without the coverage versus having the coverage. And no one is going to say that they're okay with spending $78,000. They'd rather spend $1,200 to fix that problem that they have. So again, I know I sound like a broken record, but I don't have any problems with these policies for premiums. I don't get rejections on that, because when I do my homework and I show them, why they need it because of the changes with Medicare and what their out of pockets are going to be right in their backyard, they want to fix it. Now we're going to transition into the hospital indemnity policy. Medicare this year, MA took over Medicare supplement. Which is unbelievable to me. If you'd asked me 10, 15 years ago if Medicare Advantage would be surpassed MedSup, I'd have bet the farm that it would never, but I would have been wrong because it has. So what Medicare is doing, because of that chart that I show you with the $156 billion taken out of MA, they're wanting as many people to transition to Medicare Advantage, because as we know, when they're in the Medicare Advantage plan, they're not going to get the claim bills. The private carrier is going to get it, like Aetna. So they want to do as many people into Medicare Advantage as they can. And they also offer them with all these additional benefits. So that helps them. And as we can see, it keeps growing. There's a lot of people getting into the MA business. So what does the Flex do for you? This is exactly what it does for you. As you can see, it has a whole lot of benefit that you can help your MA clients with. I don't generally use the lump sum I usually customize my policy, the hospital flex, to the MA, because you can customize it to their days that they have. Like if they have a $350 a day from day 1 to 5, I'll customize it. I'll give them $400 a day, and then I'll give them 8 days. And this is the reason why I give them 408 days. Their cost right now is $350 per day. Next year it might be 360, and the year after that it might be 370, and the next year after that it might be 380. So I give it a cushion for the policy to keep up with the changes that the MA plan is going to implement over the coming years. I give them extra days because with this particular policy, a period of care for the hospitalization is every 60 days. So if they go into the hospital in March and they utilize all their 5 days, if you just gave them 5 days, they will be unable to utilize their hospital indemnity for 60 days. So you can use the hospital indemnity 6 times a year. But if you give them 8 days and they stay in their 5, they don't have to wait the 60 days because they have 3 additional days still available to them. So that's just a little thing that I've picked up over the years. So you don't have to wait for that 60-day period of care. If you give them extra days, they have that extra 3 days to go right back in. And I always give them a little extra to keep up with the cost are. But they have the ER rider on there. They have the surgical benefit on there, the rehabbing, outpatient rehabbing, because a lot of the MA plans is $65 a visit or $45 a visit. The cancer rider is huge, up to $20,000. They have a doctor visit, and then have the skilled nursing up to $500. So when I'm selling these particular plans, I let them know the biggest out of pockets that you're going to have is your inpatient hospitalization, your recuperation, and cancer. That's how I go about it. And then, as with the recovery care, I want them to know what their out of pockets are going to be, and then how we're going to fix it to where they have zero out of pocket. So I like to spend their money, but I also show them how they can invest their money versus a premium versus having to take the chance of spending out of the pocket when they have an accident, sickness, or surgery. The additional benefits, I go over them. That's one of my, icebreakers when I'm in a house. I ask them if they have any questions on their additional benefits. A lot of them have questions about the flex card, the over the counter, or if they get groceries. So I'll go at a high level and address those questions to them and give them the answers. And then I'll explain to them, these are the free additional benefits, but there's also additional benefits that have a premium fixed to them. And I will ask them, early in the conversation, when I know that they're an MA and I go into the house, I ask them, who do you have for your hospital indemnity plan? I only have Aetna. Like, no, who do you have for your hospital indemnity? If you have an accident, sickness, or surgery and you have to go in the hospital, who's paying your hospital copay? Well, I don't have anything else. And they'll fumble through their purse and they'll fumble through their wallet. And then I propose that as one of those additional benefits that has a premium associated with it. So it's a good intro to get their mind thinking that they're missing something, and part of the additional benefits, because a lot of them are curious about those additional benefits. So that's how I utilize the additional benefits when I'm in a house. So as you can see, the enrollments for MA are continuing to grow. They're going to continue to grow unless the government steps in and does something. But what I have found with a lot of MA people, they don't remember that they have a copay for whatever reason. So these are the 3 things that I've found over my years of doing MA. When I come in, they remember that their policy is free. They get to keep their doctor and their drugs are covered. They forget that they have a hospital copay or some of these other copays. And what happens is they have an accident, sickness, or surgery, and they go into the hospital and they have a copay, or they have to go into recuperative care, skilled nursing, or if they have to take some cancer drugs or chemo and they have to pay 20%, man, they're losing their minds because they get this in the mail and they're like, what is this? Because they had the mindset that they don't pay anything, because a lot of the plans, you don't have a doctor's copay anymore, a specialty doctor copay, and it's very small. So they forget that they have these hospital copays, these recuperative copays, and then they're calling and they're asking you what's going on, and you're letting them know, hey, it's your copay. And that's the lady I don't want to see. I don't want her to feel like that, because I don't want my trust fractured with my clients. That's the most important thing as agents, is our trust relationship. So I don't want that, because I don't want them to cancel anything I have. And then this guy come in next open enrollment and blow my business out. I don't want that to happen. So when I go over to MA plans, I let them know what their big three out of pockets are going to be: inpatient hospitalization, recuperation, and cancer. And every time I sell an MA plan, I cross sell it with a hospital indemnity flex plan every single time. The ages are 18 to 89. As you can see, pays in addition to any other insurance, just like all the other ones. The EAP, highly recommend the EAP. And again, the renewals do not increase with this. So this is a spectacular policy. I love it. It's a great, great one. We know these statistics: 1 out of 5 people, will spend some time in the hospital. Observation, as we went over, 1 in 2 men, 1 in 3 women will be, diagnosed with cancer. So it has everything. I always put this in here twice just to remind you, these are the benefits that you're going to have to fix all those problems that the MA has with it. And don't forget to show them what their out of pockets are going to be without this policy, and then how they'll have no out of pockets with the policy. And again, the application is similar to the recovery care. It's yes or no questions. Just be a little bit thorough, make sure that they understand within the past 36 months, not 6 years, but the past 3 years, have you had congestive heart failure or any type of surgical? With this one, there's a little difference. If you go down to question 6, it's 40 units of insulin or less. So if they're taking less than 40 units of insulin, they're a candidate. But again, with these questions, 5 to 10 minutes, depending on if it's a single or a husband and wife. The premiums on this particular policy are awesome. As you can see, if you give all of this to them, just over $600 a year. Not bad at all. So I just don't get any pushback from my MA people when I'm cross-selling this, or when I go into a house that someone else sold them an MA plan. Here's what I get when I go into a house and I go over the information that I've gone over with you today. They're always saying, why didn't my agent enlighten me to this information? Why are you the first person explaining it to me in this way? And that's what I want to hear, because what I do out in the field or when I'm on the telesales is I don't want to sound like everybody else calling, and I don't want to sound like everybody else that's in that house. I want to be a little bit different. I want to be set apart from the other crowd. So that's why I use the observations in those videos, because I know no one else is doing that. And most MA agents aren't cross-selling. Just don't see it. And I don't understand why they're not, but they're just not. I just think that they're scared to ask for premium. And as you can see, the premiums are little to nothing. Even if you just gave them hospital and skilled nursing, it's $41 a month. It's under $500 a year. So I just don't have a problem with premiums. I think the problem is agents are just not asking or explaining it to them, because I think they're just fearful that they're not going to do it. So I tell you, I do it the other way. I ask, I let them know this is what we're going to put with your Medicare Advantage plan every single time, and I just don't have any rejections. So if you're ACA person, 18 to 89, them ACAs have a big out of pockets. Pre-existing conditions, I want to stop right there on that, because a lot of the other hospital plans that are out there with the other competitors is 6 months pre-existing. The hospital flex is only 90 days. So that's a big factor. Aetna's competition is growing. As a competitor myself, playing sports, I love competition. I think it's great in the agencies that have competition. I think it's good for the carriers to have competition, because it's good for the policyholders. But Aetna has been in the front of all of this, because, again, they've been doing these policies for over 3 decades. They're not coming into the business now because they see that it's exploding. They were in the business when no one else wanted to be in the business. They're the 4 leaders of this. They've had not one rate increase in over all those years that they've been implementing these policies. Actually, they've had rate decreases, because the last thing that I want to see my client get is one of these. They get a letter, why is my insurance going up? I've never had to use it. And then they start questioning whether they need it or not. Don't have that problem with these particular policies, because they do not have any rate increases. This is an example. I sold this guy in Florida back in 2017, and this is the benefits that I gave him. He was a retired dentist. His premium was $72.11 a month. He called me up and he said, "Hey, Ronnie, I got a problem with that Aetna." And I'm like, "Oh my goodness, what's going on?" And he's like, "I got this letter, and it's just odd, because I have, homeowners insurance and different types of insurance. And he said, this one doesn't seem right. And I was like, well, what's going on? Let me know. He says, well, I used to pay $72.11. And I said, I see that. And he said, well, I got a letter that says that my premium is $53.83. So I said, hold on. I looked it up. Yes, they had a 25% rate decrease in Florida and many other states. So how many carriers do you know that are having rate decreases versus rate increases? If you're not utilizing the Aetna Senior Products.com portal, I highly recommend for you to do it. It's real useful and it's really easily accessible. And you just go into it, you click on the agents, you log in, and then this is the homepage that you're going to see. So you can do Aetna Quote in a Row, the e-app right there. If you're not familiar with the Quote in a Row, you hit that sandbox and you can go in there and play around and make believe that you're filling out an app and practice to get the handle of quoting in a row. If you have any notifications or if they need any actions done, say you did an e-app and there's some questions that the underwriters they're going to reach out to you as the agent to ask you to give them feedback on a question that they have a gray area in. You can pull up your reports. You can see the policies that are issued. You can see lapses. You can see cancellations. You can do trainings. You can see all the trainings that I was talking about earlier. If you hit products, you can pull up the drug list because that's how Aetna is underwriting these products. So it's very important that you take those drugs that they're taking, if you're not familiar with some of them, and look on the Aetna drug list, the knockout list. Those two bottom boxes, that's what the e-app looks like. So you're going to simply answer those questions and fill in the information. And when you hit next, that next page where you see where the pink is there, the salmon color, that's where you left a piece of information out. So if you left something out, it won't let you go to the next screen until you go back and fill that information in correctly. So there's no way you can mess the e-app up because the system won't let you. So that's why I said practice on the sandbox. If you hadn't did an e-app, I do e-apps every single time for a couple of different reasons. Your underwriting is going to be really quick. Usually in a matter of a half an hour, you're going to see if that policy is approved, if it needs underwriting, or if it's declined. Last year, I had 3 declines. And the reason I had 3 declines was because my clients were on a new medicine. They forgot to tell me about it because they weren't used to taking it. And it happened to be a knockout drug. So what you want to do is you want to go under that products and hit drug list, and you can see what the knockout drugs are. So if the drug they're taking, like the Actigol for cirrhosis, has an X by it, that if they're taking that Actigol for cirrhosis, they cannot get the hospital indemnity flex. Now, let's say they're taking the Actigol and it's not for cirrhosis. That's a dual drug. So if they're taking Actigol and it's for anything else besides cirrhosis, they can get the hospital indemnity flex. Methotrexate is a cancer drug. That used to be my nemesis drug. But now a lot of doctors are prescribing methotrexate for arthritis. So if they're taking methotrexate for cancer, that would be a knockout drug. But if they're taking it for arthritis, that's a dual drug. So that's why I said I only had 3 declines last year, because I go on to the drug list and I'll punch in the medicines that I'm not familiar with to see if it's on the knockout drug for the hospital indemnity flex or the home care plus or the recovery care plan. And that way, as an agent, that it's not a knockout, the policy is going to be issued. So it takes about 4 or 5 minutes, depending on their medicines, to put them in there. And sometimes if they're only taking 5 medicines and you're unfamiliar with 1 or 2, it takes about 60 seconds. So I highly recommend for you to use that drug list, because that way you'll know what policy that they're going to be able to get. Because let's say you're pitching the recovery care and they're taking a drug like methotrexate for something, the cancer, and it's a knockout, you're going to have to switch over to the home care plus. I'd rather switch policies while I'm in a house than have to go back and visit them again or make a phone call. So I do it right in the house. That way I know what's going on. If you're not using the Aetna Quotes on the Go, highly recommend it. The reason being is because you can do quotes within 60 seconds and you can see every policy that's in that area. So you just punch in the zip code, their age, it'll pull up every policy that's in that area. You can do a quote for the cancer policy put it in the cart and go do a med sep quote, and then you have the premium within 60 seconds. So what you want to do is go into the app store and punch in quotes on the go. Don't put Aetna, but put quotes on the go, and that icon in the upper left hand corner will come up, and then you have the Aetna quotes in a row app. I have that, and that's how I do all my premiums when I'm in the house, because it takes like 60 seconds. With that being said, I talk highly of Aetna with these particular products because I've been selling these products for over a decade. They stay on the books. They do things right. They've been around for over 170 years. They've been in the ancillary business for over 3 decades. They do things right. I'm comfortable with insuring my people and giving them into the hands of Aetna, because Medicare even said, here, do the first Medicare benefit. So with that being said, if there's any questions, I'll be more than happy to give you the answers. And if I can't give you the answer, I'll get back to you.
Ronnie, thank you so much. All that information was phenomenal. Just having the information and the knowledge and what Ronnie can give to us and what he gave to us. And just the things that we, a few things that I took on that was, everyone go, like I always say, excuse me, like I always say, our clients don't know what they don't know unless we tell them. We have to be proactive in this. We have to be respectfully aggressive. We have to be, we have to want to do this. Like Ronnie said a couple of times, show them the want, show them why they need this. Give the passion to them. If you have the passion behind what you want to show them and you believe in it, they're going to want to follow your lead. The Genworth app is a great app. Everybody download it, get it, because it really gives you some great information in your area and just shows your expertise. All those products that Aetna has, the brand name recognition. Of course, we love quotes on the go. Make sure you have that on your phone. But all the information that you have at your disposal, what Ronnie gave you, the information that that you have available to you, what he just went this last hour showing you, is another reason why you need to be proactive in doing this. The amount of agents, like you said, like Ronnie said, who do you have for your hospital indemnity? And they'll look at you with deer in the headlights. What are you talking about? Because no one's talking to them about it. 1% of the agents talk to their clients about hospital indemnity and cancer. Let's move that needle because your clients need it. What it does for your book of business is a totally different, need that you have to have. But what it does for your client and the peace of mind is what we're there for, and to make our clients their lives easier. And when it does come up, Ronnie, anything you want to give and any closing comments before we sign off?
Yeah, just very quickly, I'll just tell you, that's how I make my money on these products, because they're low hanging fruit. And like I said earlier, I always get when I'm in the house, why didn't my agent enlighten me to this information? Why are you the first person explaining it to me in this way? And you hit the nail right on the head, Joey. People aren't out there projecting that information to their clients for whatever reason. I'm telling you, I make a ton of money in the field by running burns, which is my agent's burn list that they couldn't sell them by. And I take a burn and I go in and sell these products because I'm giving them a high level of why they need this. So the way I do my presentation, the dots connect for them, the light bulb comes on, and they're asking me how to fix it. I don't have to close them.
Exactly. And that's exactly because you give them the information, and everyone, again, if your clients don't have one, keep one with you. And what Ronnie was saying on page 28 of your Medicare and Me handbook, that right there, that page right there in itself is one of your main selling tools. So, Ronnie, thank you for your time. We're going to have a podcast here. If I can ever get you back on, and I know you're a busy man, but my time and your time in the business and our thoughts align great. Justine, thanks for aligning Ronnie with us, for a better word. And Ronnie, looking forward to talking with you very soon in the near future. And safe travels to you. Everyone have happy holidays. And Ronnie, Justine, I will talk with you all soon.
All right. Thank you, Joey. Y'all have a great day. Go get them, guys and girls.
Thank you. Great. Thank
Get
you.
them. Happy selling.
Thank you.